This is a demonstration of Chapter 14, the Statement of Cash Flows. This is for Learning Objective 14.4, preparing the statement of cash flows using the direct method. As we said earlier, the Financial Accounting Standards Board actually prefers the direct method of reporting cash flows from operating activities. This is because the direct method provides clearer information about the sources and uses of cash than does the indirect method. Investing and financing cash flows are presented exactly the same under both the direct and indirect methods. Only the operating activity section differs between the two methods. When using the direct method, we take each line of the income statement and we convert it from accrual to cash basis. So in essence, the operating activity section of the direct method cash flow statement is really just a cash basis income statement. The first item on the income statement is sales revenue. Sales revenue represents the total of all sales, whether for cash or on account. The balance sheet account related to sales revenue is accounts receivable. So we can see by analyzing the accounts receivable balance that the actual cash receipts that were received for the sales was $269,000, whereas the sales revenue that was reported on the income statement was $286,000. So by looking at the change in accounts receivable, which was $23,000, and subtracting that $23,000 from the sales that were reported on the income statement, we could also determine that the actual cash receipts was $269,000. So we would present this using the direct method in the operating activities section by showing first cash flows from operating activities, then receipts, and then showing collections from customers of $269,000. The next type of cash receipts would be cash receipts of interest revenue. The income statement reported interest revenue of $12,000. Because there is no interest receivable account on the balance sheet, we know that the entire amount of interest revenue must have been received in cash. So the statement of cash flows should show interest received of $12,000. The income statement also reported dividend revenue of $9,000. The balance sheet account related to dividend revenue is dividends receivable. However, there was no dividends receivable account on the balance sheet. Therefore, the dividend revenue must also have been received in cash. So the statement of cash flows shows cash received from dividends of $9,000. Then we total those three types of receipts to get total cash receipts of $290,000. Next, we're going to determine the payments or the uses of cash. The first will be payments to suppliers. Payments to suppliers are going to include all of the payments for merchandise inventory and all operating expenses except employee compensation, interest, and income taxes. So remember that suppliers are often also called vendors, and they are the entities that provide the business with its merchandise inventory and other essential services. So first, to determine the cash paid for inventory, we're going to use cost of goods sold, merchandise inventory, and accounts payable. On the income statement, cost of goods sold was $156,000. Merchandise inventory decreased from $145,000 at December 31st, 2023 to $143,000 at December 31st, 2024. So the decrease in merchandise inventory of $2,000 would need to be used to adjust cost of goods sold. But we also need to look at accounts payable. Accounts payable increased from $50,000 at December 31st to $90,000 at December 31st, 2024. So we use the increase in accounts payable of $40,000 again to adjust cost of goods sold. So we start out with cost of goods sold from the income statement of $156,000, subtract the beginning balance in merchandise inventory of $145,000, add the ending balance in merchandise inventory of $143,000, add the $50,000 balance in accounts payable at the beginning of the period, and subtract the $90,000 at the end of the period. That gives us actual cash payments to suppliers of $114,000. So we would show that along with the cash paid for operating expenses. So to determine the amount paid for operating expenses, we look at the account accrued liabilities and the amount that is shown on the income statement for other operating expense. So we take the amount from the income statement for other operating expense of $16,000, add the beginning balance in accrued liabilities of $10,000, and subtract the ending balance in accrued liabilities of $5,000, and we determined that the actual amount of cash payments for other operating expenses was $21,000. So we add together the $21,000 from other operating expenses and the $114,000 for cash paid to suppliers, and we get a total to suppliers of $135,000. Now that would be a subtraction because that is a use of cash. The next item is payments to employees. This category includes payments for salaries, wages, and other forms of employee compensation. Accrued amounts are not cash flows because they have not yet been paid. The accounts related to employee payments are salaries and wages expense from the income statement and salaries and wages payable from the balance sheet. Because there isn't a salaries and wages payable account on the balance sheet, the salaries and wages expense account must represent all the amounts paid in cash to employees. So the statement of cash flows shows cash payments to employees of $56,000. Next, we need to determine the payments for interest expense and income tax expense. These cash payments are reported separately from the other expenses. The accounts related to interest payments are interest expense from the income statement and interest payable from the balance sheet. There is no interest payable account on the balance sheet. So the interest expense from the income statement must be all of the amounts were paid in cash. So the statement of cash flow shows cash payments for interest of $15,000. The accounts related to income tax payments are income tax expense from the income statement and income tax payable from the balance sheet. Since there is no income tax payable account on the balance sheet, the income tax expense on the income statement must have all been paid in cash. So the statement of cash flows shows cash payments for income tax expense of $14,000. We would then add all of the amounts under payments together to get a total cash payments of $220,000. Now, non-cash expenses and gains or losses on disposal of long-term assets are reported on the income statement, but they're not included in the operating activities when we use the direct method. So the indirect method adjusted net income for these items, but when you use the direct method, you just skip over all of those items that are non-cash transactions in the operating activities section. This slide shows the completed net cash provided by operating activities using the direct method. To calculate net cash provided by operating activities, we would add all the cash receipts and cash payments described previously and find the difference. So for Shop Mart, the total cash receipts were $290,000 and total cash payments were $220,000. So net cash provided by operating activities is $70,000. If you remember from the previous presentation, using the indirect method, we determined that the net cash provided by operating activities was also $70,000. The amount is the same. Only the method by which it was calculated is different. And if you notice, the remainder of Shop Mart's statement of cash flows is exactly the same as we calculated using the indirect method. So this slide shows the completed statement of cash flows using the direct method for operating activities. And that is the conclusion of the presentation for Learning Objective 14.4.